18 months. That's the approximate window before the next massive financial reset begins separating those who prepared from those who didn't. Not 3 years, not 5, 18 months. I don't say that casually. I've spent decades studying economic collapses, sovereign debt failures, and monetary breakdowns across centuries of history. Every major indicator I track, credit expansion, sovereign debt saturation, currency debasement trends, and liquidity cycles, is now flashing the same warning signal. We have entered the late phase of a long-term debt supercycle, and historically this phase has erased between 50% and 60% of traditional investment portfolios. But here's the part most people never hear. That destruction is not random, it's a transfer. A transfer of wealth from those positioned incorrectly to those positioned strategically. And over the next few minutes, I'm going to show you the 4 asset classes that have consistently survived and often thrived during every major debt collapse in modern financial history. But before we break those down, I need to tell you a story. Because statistics educate people, stories move people, and this story explains why what you're about to learn could determine the quality of the rest of your life. In late 2006, I met a man named Daniel. Daniel was 55 years old, a disciplined mechanical engineer who spent 3 decades building what most people would call a dream retirement fund. He had accumulated roughly $1.9 million through careful saving, consistent investing, and following every piece of mainstream financial advice available. He held a balanced portfolio, 60% equities, 40% bonds, managed by a respected advisory firm charging nearly $22,000 annually in fees. When Daniel sat across from me, I shared concerns about systemic leverage in the housing sector, the explosion of derivative exposure inside major banks, and the rising fragility of credit markets. I explained we were approaching the final stage of a debt expansion cycle. I told him portfolios built on traditional diversification would likely suffer catastrophic losses, and I explained that, historically, only a small group of asset categories preserved purchasing power during these periods. Daniel listened politely. Then he did what most intelligent, responsible investors do. He trusted his advisors. They showed him long-term market charts. They reassured him downturns were temporary. They emphasized patience and discipline. They told him to stay invested. So he did. In early 2007, markets continued rising. Daniel's portfolio grew past $2.2 million. He and his wife began planning early retirement. They placed a deposit on a coastal vacation property and scheduled a European cruise for the following year. By mid-2008, everything changed. Within roughly 16 months, Daniel's portfolio lost over 52% of its value. His $2.2 million fell below $1.05 million. Decades of disciplined saving cut in half. His advisor repeated the same phrase investors always hear during collapses: "Stay patient, markets recover." But Daniel didn't have the luxury of time. His retirement projections required compounding growth over the next decade. Instead, he spent the next 12 years trying to rebuild. I spoke with him again recently. He is now 73, still working. Not because he loves working, because he cannot afford to stop. The house never happened. The cruise never happened. His retirement years became survival years. And here's the painful truth. Daniel wasn't careless. He followed the rules. He trusted conventional financial wisdom, and it failed him. If you think Daniel's story is rare, it isn't. It happens at the end of every major debt cycle. And to understand why, you need to understand how the economic machine actually functions. The global economy runs on 3 primary forces: productivity growth, short-term credit cycles, long-term debt accumulation cycles. Productivity is straightforward. Producing more output per worker over time increases prosperity. Short-term credit cycles typically last 5 to 8 years. Credit expands. Spending accelerates. Inflation pressures rise. Central banks increase interest rates. Borrowing slows. Recession follows. Then stimulus restarts the cycle. That explains regular recessions. But beneath those smaller cycles lies a much larger one most investors never notice: the multi-decade debt supercycle. Over decades, governments, corporations, and consumers continuously accumulate obligations. Eventually, debt grows faster than economic output. At that point, the system reaches mathematical limits. And historically, when societies reach that threshold, they face only 3 solutions: default on debt, restructure obligations, or inflate the currency to reduce real debt burdens. And across 500 years of financial history, governments overwhelmingly choose inflation, not because it is ethical, because it is politically survivable. They don't call it inflation, they call it stimulus, quantitative easing, liquidity support, monetary accommodation. But in reality, it means increasing currency supply, which reduces the purchasing power of savings and fixed income assets. Right now, total U.S. debt has surpassed $90 trillion when combining government, corporate, and consumer liabilities. Federal interest payments alone now exceed spending on many major national programs. Historically, that level has never been sustainable long-term. And every time societies have reached this stage, traditional financial assets, especially long-duration paper assets, have suffered severe real losses. This isn't speculation. History gives us case studies. During the Great Depression era, equity markets collapsed nearly 90% peak to trough. Numerous bonds defaulted. Savings were wiped out. During the inflationary crisis of the 1970s, bond investors lost massive real purchasing power. Stock markets stagnated for over a decade after adjusting for inflation. But in both periods, a small group of asset classes consistently protected wealth. Which brings me to another story. A woman named Evelyn contacted me in 2012. She was 69 years old. Recently widowed, her husband had retired with what they believed was a secure $1.5 million portfolio built through disciplined investing. When the financial crisis struck, they lost nearly half their life savings. Evelyn told me something that stayed with me for years. She said the real damage wasn't the money. It was watching her husband lose sleep, lose confidence, and deteriorate emotionally under financial stress. She told me if she could reverse time, she would gladly sacrifice potential upside in exchange for certainty and stability. Because financial stress doesn't just steal money, it steals time, health, relationships, peace of mind. And that's why the next part of this conversation matters. Across centuries of monetary resets and debt collapses, 4 asset categories have repeatedly preserved wealth when paper assets failed. Let's break them down. The first category is physical precious metals, not paper proxies, not derivatives. Tangible, owned bullion. Gold and silver have served as monetary anchors across civilizations because they cannot be printed, politically manipulated, or artificially expanded overnight. During inflationary monetary crises, precious metals historically absorb currency devaluation. They are not designed for aggressive growth. They function as financial insurance. Insurance often feels unnecessary during prosperity, but during currency debasement phases, it becomes priceless. Historically, investors allocating roughly 10% to 15% of liquid wealth to physical metals have significantly reduced portfolio volatility during monetary instability. The second category involves businesses with pricing power, not simply stocks. Businesses capable of increasing prices faster than input costs. These companies typically share 3 traits: strong brand or service dominance, essential product demand, consistent cash flow generation. During inflationary periods, companies producing necessities, consumer staples, healthcare providers, infrastructure utilities, and energy producers historically maintain profitability while weaker companies suffer margin compression. These types of businesses convert inflation pressure into revenue expansion. The third category is short-duration sovereign liquidity instruments. In simple terms, safe, short-term government securities and cash equivalents. This portion of a portfolio is frequently misunderstood because it appears boring. But liquidity is power during crises. Every major financial panic creates rare buying opportunities. Investors with available capital during panic periods historically generate disproportionate long-term returns. Liquidity provides optionality, the ability to act while others are forced to react. The fourth category is productive real assets, assets that generate essential goods or services regardless of currency strength. Agricultural land, income-producing real estate, energy infrastructure, resource production assets. These assets maintain intrinsic value because they produce necessities humans cannot live without: food, shelter, and energy. During historical inflationary environments, real asset income streams frequently adjusted upward alongside cost of living increases. Now here's where most investors make a dangerous mistake. They either ignore warning signals completely. or they panic and make sudden, emotionally driven decisions. Neither strategy works. Wealth preservation during late debt cycles requires systematic repositioning, not impulsive liquidation, not market timing. Strategic reallocation. The speed of repositioning should depend on one critical variable: time horizon. Investors with decades until retirement can transition gradually. Investors approaching retirement face significantly higher risk exposure and historically benefit from faster defensive positioning. The most effective transitions historically follow a staged approach. First, reduce highly speculative positions lacking sustainable cash flow or intrinsic value. Second, gradually build defensive asset allocation over multiple months to average entry points. Third, maintain emotional discipline while markets fluctuate, because late-cycle markets often rise before collapsing, creating false security. Fourth, implement written allocation systems. Emotional decision-making historically destroys capital during volatility spikes. Here's the uncomfortable truth most financial professionals rarely explain openly. Advisory models often prioritize asset growth within managed funds, not necessarily risk reduction outside them. Assets like physical metals or direct real assets typically generate little advisory revenue, which creates structural bias toward traditional asset allocations. Understanding that incentive structure is critical. Let me be completely honest about what usually happens after conversations like this. Most people intellectually agree. Then they delay action. They wait for confirmation. They seek reassurance. They postpone uncomfortable decisions. And historically, by the time financial crises become obvious to the public, defensive repositioning becomes exponentially harder, because the biggest financial losses don't happen gradually. They happen suddenly. And recovery timelines stretch across decades for investors near retirement age. So here's what I want you to do. Not next year. Not someday. This week. Review your entire investment portfolio, every fund, every stock, every asset allocation. Ask one brutally honest question. If a prolonged inflationary debt crisis begins, does this asset preserve my purchasing power? If the answer is uncertain, flag it. Then design a repositioning strategy over the next 3 to 6 months based on disciplined allocation targets and clear timelines. Because emotional decisions during financial crises historically lead to catastrophic mistakes. Fear triggers panic selling. Greed triggers bubble buying. Hope traps investors in failing positions. Systems protect investors from themselves. History shows debt supercycles rarely end gently. They end with massive financial restructuring. And historically, the investors who prepare before crisis visibility preserve independence. Those who delay preparation often spend decades recovering. We are approaching the final stage of a generational debt expansion cycle. Preparation windows historically close quietly, then permanently. 6 months from now, you may thank yourself for acting early, or regret ignoring warning signals. The decision is entirely yours.